are back with another stock analysis. Today we'll be looking at Estee Lauder. They are basically a makeup, skincare kind of product company. One of the larger ones, one of the big players in that industry. So, I mean, should be a pretty solid company, you would think. But their stock has been declining basically for 3 years now, and not too many signs of it really coming back up at the moment. So we are going to look into them, see if they are undervalued now, and basically get into their financials, go through a valuation, go through their earnings a little bit, and that's about it. So if you're interested, make sure to subscribe. I make these videos basically every day. And yeah, let's get into Estee Lauder. So market cap for them is at 24, just under $25 billion. So it is still a very large company. 2% dividend yield. And if we look here, target price is at 75 and their growth rate is actually at 25%, which is definitely not like bad. I mean, that's very high. Current price is at $70 a share, so about $5 off of that target. If we look at the mini chart here, we can see they have really been underperforming since basically the beginning of 2022. And actually, if we get in here and just go right to their full chart, we can see really how far they have fallen. Right now, they're at prices that they haven't seen since 2013. So basically 12 years of stock growth just completely wiped out. Not great. If they go any lower, they're basically going to their next like very significant support area is right around the 15-ish to 20 high 20s range where they've been bad. This area for them kind of has a lot of volume, as you can see, or a lot of activity, I should say. Right between 28 and I would say upwards of 15 here. So that is if they break through even more support here. So probably the $65 range as well as the right around low 50s. And then after that, the $40 range. I'm just looking at like where significant lows are on the chart here. But overall, I don't think they will go that low by any means. But if they did, those are kind of where their support areas would most likely be. Looking into their growth summary here, it is fairly mixed. And also the arguably most important one here, which is sales, is very, very low. 3.6% over 10 years is terrible. That probably won't even beat inflation. Not good at all. One thing to say is that free cash flow is positive long-term, which is arguably pretty good. And I mean, the dividend growth is clearly very consistent, but overall, very bad across the board here with their growth estimates. And saying that, let's get into their income statement. So once this loads up for me here, we will take a look at how they've been doing. And we do have fiscal quarters, or I'll look at fiscal years first. So fiscal years, they have been basically stagnating in sales, actually decreasing since 2022. They actually saw an uptick in 2020 during the kind of the middle of the COVID pandemic. 2021, they saw more sales, actually a lot more sales. But since then, they've been declining. And it looks like we are just above 15 billion in sales right now after a high of 17.7. So not great there. It looks like if we go into their profitability here, their profitability is nowhere near where it used to be. Even in 2014, when they had 5 billion less in sales, their operating income was much higher than it is now. If we look at their net income, they actually had a loss. Last 12 months of the December quarter for 2024, they had a net income loss here. They have not had a loss in 10 years, year over year. And also, they haven't seen numbers this low since either COVID or pre-2014. So overall, very bad across the board. Profitability is terrible, decreasing, does not look great. One other thing to note is that their total shares have also started increasing as well. So it looks like they saw a low of around 357 million shares, and now they're estimated to be at 359, which isn't really significant at all. It's very little change, so not too important there. But saying that, let's go into the balance sheet now and see how they're doing. So 3.4 billion in cash at the moment. And this is for the fiscal year, actually 2024. So 3.4 billion in cash. We see about 10 billion, just under 10 billion total in debt. So about a third of that is coverable, should it need to be, which is okay, especially for a larger company. That kind of ratio is fine, especially considering the short-term debt is completely coverable. That is a good thing. Total assets have been decreasing year over year. They saw about a 3 billion decrease. Right now, they're about at the same level they saw during COVID. Whether or not that is good or bad is kind of up to individual interpretation. I would say based on the fact that their profitability is much less, but yet they're at nearly an all-time high in assets, or at least much higher than they used to have. That is not great at all. Actually, pretty bad. So that part is definitely not good. Let's move into the cash flows now and see what we're looking at. So operating cash flows are looking good. 1.8 billion in the past, or I should say, LTM past 12 months from the last quarter. 2024 looked pretty solid. We did see an uptick there from 2023, which for net income and things like that, we did not see. So that is something to say at the very least. But overall, I would say it is consistent with the rest of their performance. Investing activities, we can see a lot of acquisition activity actually here. They've been spending billions of dollars on acquisitions and things like that, which is good. But at the same time, all of this money spent and their profitability is down and their sales are down. So saying that, is it really a good thing to be making so many acquisitions? Not really. Moving on, not too much investing activity in the past couple years, a little bit of selling, and that's about it. Financing activities, we can see that consistent dividend, which has increased massively over the past few years, which is cool. But at the same time, it looks like it will be lower coming soon, which will definitely decrease a lot of confidence for a lot of investors. So not fantastic there. Also, issuance and reduction of debt. It's mostly issuance with very slight reduction in between, but a lot more issuance in the past few years. And then free cash flow is very consistently positive, which is good across the board. We're seeing a lot of positivity, so nothing really negative there at all. Let's move into their ratios now and see how they've been doing. So we should see long-term declining ratios here. So gross margin is at 71.5, down from the 5-year average, slightly up from 2023, but just look where they were a couple years ago, 75 even in 2020, which I don't realistically, they shouldn't have done anywhere near as good considering most of their products are sold in stores. So 4% higher in the global pandemic year compared to now is not great. 2014, 10 years ago, they saw almost 10% higher in their gross margin. SG&A to sales is also much higher than their 5-year average, about 4% higher. And that has been right around the same amount for the past 10 years for them, other than a big increase or decrease in 2021 and 2022. So that does stay fairly consistent. So this is a little skewed for those 2 years where they did a little bit better with it. Operating margin is about 6% below their 5-year average. So not great there. Net margin is massively below, about 6% as well. Not great. Actually, it's about 7% lower than their 5-year average. Huge decrease from 2023, massive decrease from the years prior to that as well. So overall, just terrible performance with their margins as a whole. Looking at their debt to equity. So I said earlier, their debt situation isn't that bad. Honestly, seeing this total debt to equity at 184%, 5-year average is 172, so way higher. That is not good at all. A healthy level for a company would be below 80%, even below 100 to 80%. Anything below that is fairly healthy, but 185% here is not good at all. Way too much debt for this company. They're very much over leveraged. And I mean, clearly, even with all of the debt that they took out and all of that extra funds that they should have, they have not been able to really perform well with that at all. So saying that, let's go into their last earnings report and see what they've been doing. So their fiscal year starts fairly early. So we're at Q2 of their 2025 year. And first, let's look at the metrics recap and see what's been going on. So a lot of different things here. For products, skincare came in at a beat, makeup is in line, fragrance beat, hair care came in below, and their other segment came in slightly above as well. Geographies, America's revenue was down 1.5% year over year. Europe, Middle East, and Africa down 6% year over year. Asia Pacific down 11% year over year. Organic growth was down 6%, slightly beating estimates, but even still 6% negative organic growth is just bad. So no matter what, those numbers are not good, but beating the estimates slightly, I guess, is a little positive, but even still not great. Operating incomes. So their only product currently that has a positive operating income is skincare. Every single other product line that they carry is losing hundreds of millions of dollars. So not great. Looking at their operating income through their geographies, the Americas had a massive loss compared to the prior year, $823 million loss compared to $55 million a year ago. Terrible acceleration of their losses. So not good there. Europe, Middle East, and Africa saw a 16.6% decline. However, they were the only, or not the only one, but they were profitable, or at least they had an operating profit, which is good, but still that decline is very, very bad. Asia Pacific saw a 58% decline in operating income year over year. That is terrible. That basically just destroys the entire segment. However, to be fair here, it is still profitable, which is something at the very least compared to their Americas segment. So overall, that's not that bad, but still it is 58% decline no matter what is terrible. So looking at margins, their gross margin actually came in above estimates, which is a little surprising, as well as operating margin. This is non-GAAP, to be fair, so it doesn't take into account the actual reporting metrics that are actually seen like in their official financial statements. So it is a little bit different. But overall, beating these margins is shocking just based on the numbers here that we've seen. I don't know how that would even happen with those margins being beat or those margins even being positive, but overall they were. So that is something. Next, let's go into the street takeaways and see what is happening here. So shares were down 16% off this earnings report. I'm only going to read this overview part. If you'd like to go through the analyst commentary, feel free to pause here and read through it. But looking over the overview, modest upside on the top line in skincare and fragrance was somewhat mitigated by hair care, expansion of profit recovery and growth plan to include, I don't know what exactly RIF means, but I'm assuming that is reduction. They're most likely doing job cuts of 5,800 to 7,000 jobs. I think that's what that means. But anyway, quarter three guided below on the top and bottom lines. Not great there. So quarter three 2025, which is the next quarter they'll be reporting, they've reduced guidance very significantly, which is not good. Quarter two was ahead of expectations. The disappointing outlook for quarter three was credited for the 16% decline. Analysts were mixed on announcing initiatives from the new CEO. So another new CEO similar to Papa John's, which I just reviewed earlier, which as always could be a positive thing. I'll bring up the Starbucks example once again. Starbucks just got a new CEO and their stock price has been performing fairly well from it. So that is something that you can be optimistic about, but overall it just takes time to see where it'll be heading. Some noted a history of success for the company with the approach outlined, while others see increased complexity in new leadership structure and feel divestitures should be considered. Furthermore, issues with travel retail were seen continuing to weigh in. So I would say this is mostly negative, actually overwhelmingly negative. Lowering their top and bottom line guidance for quarter three is not good at all. They're expecting to perform worse than already their bad performance has been doing. To be fair, their quarter two apparently was fairly good, which based on the numbers I've seen, it wasn't the best, but it did outperform their already not great estimates. So that is something, but quarter three looks like it will be much worse, and they're expecting it to be much worse. So saying that, let's go into a valuation now and see where they stand up versus their competitors. So hopefully it'll come in at undervalued here. That's kind of the best case scenario. So average here is 27.14 and 24.76. So let's put that in here. 7.14. And of course I forgot 24.76. And that gives a whopping valuation of negative $50. So with the function that I use through my spreadsheet here, they're showing at a negative EPS right now, which is also why there is no EPS currently listed for Estee Lauder here, because their earnings per share are negative. What I could do is use one of the PE ratio estimates here. Also, if I go back, there is a whole tab here for the EPS where you can see the fiscal year 2024 final EPS I could use. That would give them a PE ratio of 41, however, and we'll see exactly why that's bad when I put that in here. So 2.59 was their average for 2024. So that is what I'm going to go with. And the reason that is not great is because when I put this in, we will see a undervaluation with a downside of not that much, to be fair, of 4.76%, but it is undervalued compared to their multiple different competitors. If I wanted to use the 2025 estimates as well and say 1.41, which I can put in right here, it would be even worse at a valuation of $36 a share with an almost 50% downside. So overall, does not look great. I could also use the 0.64 estimate here for their most recent quarter and go with that. And actually, 0.62 would be their most recent quarter. So realistically, because we're halfway through, this would be the most accurate number. This is the most recent report, is this 0.62. So if we put that in here and we look, we're seeing an even worse downside. So this is probably this is the most up-to-date EPS, not including their current negative EPS. So overall, is there a 77% downside here? Possibly. Based on the way they've been performing, it wouldn't shock me. I did say earlier, if they do break the support on their chart, we could be seeing them return down to this high support range where that valuation would fall very, very comfortably within. So that is something to consider. I don't think this company has a lot of very positive things going for them. Obviously, a new CEO could be positive, but overall, we'll have to just wait and see. This next earnings report is going to be huge, which obviously this one did just come out, but the next one, I mean, I basically always say this, but the next earnings report is the most important one. And it's kind of always true, but overall, I would say there's just a lot of very deep systemic issues with this company, especially profitability. So a lot of issues that aren't really being fixed and are mostly getting worse. So that's about it. That's my opinion with Estee Lauder currently, based on what I've seen. Feel free to do your own research. Let me know what you think about the company in the comments. Tell me if I'm right. Tell me if I'm wrong. Maybe give your own price targets. Do whatever. That's all I got for Estee Lauder. Make sure to subscribe if you'd like, and I will see everybody in the next video. Thanks for watching.